want me to start bringing everyone through? It is, yes, I read the wrong bit.
Hi. Okay, I think Jamie doesn't have keys. Right, don't worry, let me get some.
We need to sign the registration now.
CBD.
Yeah, so that's probably worth.
Counting points, what they call them.
Yeah, exactly.
You can probably just do the thing with me.
Yeah, I text you about it. Yeah, thank you. You're bringing it to that one, not through that. Yeah, the week is back and they're gonna get. I know. Yeah. Thanks, Scott. All right, I'll make sure. And what we'll do is we'll leave that for now. We'll do that at the end. We just want to. I have to run out. So can I just do one there? Is that okay? Yeah. Thank you. Oh, what's going on there? Oh, don't worry. Honestly, that we'll deal with it at the end. Thank you. Substance speakers notes, pen and the cash, Q&A. No, I couldn't find one. Wasn't there is one? It was by John. Don't worry, I'll get it. Well, I looked to see if the speakers were separate, and I also looked. Okay, I'm the person doing it. Either way, so it doesn't matter what I put it that. I'll pick it up for the reception. Okay. You need to go here.
Yeah.
What time is it finish?
I've got to shoot back on 5.
It's a 6:15, but it is going to be recorded and it will be on our YouTube channel. So
brilliant.
watch it from home. Really good.
funny enough, I'm setting up a health and safety at first. So, how many minutes apart?
Okay, yeah, that's right.
What do you look at? Yeah.
Yeah. I haven't been in person to one of these before COVID, and all my pens have run out. No, I took. Yeah, go ahead, grab as many as you want.
You actually do
Take a copy of the speaker's notes.
I think it looks good in front of clients.
Thank you.
Let us know what you think. It's everyone that's right.
Yeah, he literally is.
Thank you. Been long there. If I can't work.
Thank you.
Even into my. I'm your pen.
I'm going to take a step for a colleague who couldn't make it.
Sorry. We will take in rent, so we can't find a call. I know. Yeah.
One of these.
One of these.
I just one speaker's notes.
Yeah. They don't like me to One of each.
Yeah, one questionnaire, one set of speakers notes.
I didn't take it. Just all gonna say.
Didn't want to put them all in one big pile into this thing, fell over.
Sorry. I didn't say you doing. Nice to see you. How's it going?
Hands are a bit sweaty.
Oh, don't worry, that's fine.
Yeah, that's a good reason.
Oh, yeah, yeah.
One set of speakers notes and then. Thank you. Take as many as you want, you've got plenty of.
You should have asked that. Yeah, okay, so, all right, okay. I guess I'll go down the side.
Find a spot.
Yes, yes.
There you go.
Well, good afternoon and welcome to everybody here at the Ashworth Centre. Welcome to those who are watching online and welcome to those who are watching us in the future on YouTube, because I should say this lecture is being recorded. Just the lecture, we're not recording the questions session at the end, which I think is rather a pity, because actually the most interesting part of the whole session will be the questions at the end. But that's the advantage of those who have actually turned up here in person or online, because you will hear that and nobody else will. Also, those who are here in person have another bonus, which is the opportunity to have a drink afterwards. And I hope you will stay and have a quick drink. Or actually, I don't hope you'll have a quick drink. I hope you'll stay for a drink, even if it's only a quick one. Now, this lecture is one which I've never done before in one respect, and perhaps hasn't been done before, because this afternoon I typed into chat GDP this question. Please explain the advantages and disadvantages of a family investment company in the UK for UK tax. I propose at the end of my lecture to give you the answer which chat GDP gave. It's a sort of Kessler versus the computer. Yeah, and we can see who you think has done a better job. I won't give that away until the end. We are on tenterhooks. So, alternatives to family trusts. What can we do if we can't use trusts? Your lecture notes from this, you'll be pleased, and I'm not going to go through them all in full detail. You'll have the opportunity to read them later. They come, needless to say, for those who know me from my book, Taxation of Non-DOMs, in accordance with the Chamber's Constitution. I'm allowed to give one plug and one plug only to my book, so I've now done that. The only thing I would say about it is that the title is now misleading, because it covers rather more than non-residents and non-DOMs. It's gradually expanded into other topics. What I'm really looking for is a new title. Giles Clark got there first with offshore tax planning, and I haven't found anything. So if anyone here can think of a good title for my book, please speak to me afterwards. Anyway, so what have we got? Why conventional trusts ruled out? I think everybody here will know the answer to that question. We have inheritance tax entry charges, and we have inheritance tax 10-year charges. You might possibly be able to avoid the entry charge. For instance, I can make a loan to the trust. That wouldn't be a transfer of value. I can make a gift of the loan to my children if I wanted, in which case I'm just left with the 10-year charges. But I think 10-year charges are quite a serious drawback to discretionary trusts. It's 6% every 10 years. It doesn't sound like much. And people may say, well, over a lifetime, it's about the same as a 40% inheritance tax charge. But it's not. It's not for various reasons. Firstly, you pay it sooner than the tax charge on death. And secondly, the ordinary inheritance tax charge you can avoid to the extent that you feel like it by making lifetime gifts in good time, by making pets. So the effective rate of tax on an individual's estate is likely to be well under 40%. Whereas if it's in a trust, 6% every 10 years is what you pay. And those two charges, to my mind, just rule out trusts in most cases, subject to a few exceptions, which I've put here, paragraph 1.1 of my notes. Nil rate band amounts now frozen until the year 2028, so decreasing and will continue to decrease. Business property relief, well, that's fine. If you have that sort of property, then a trust is maybe ideal. IPDI trusts, interest in possession trusts created by will, as far as that goes. Not very far. Special release, disabled beneficiaries, pension funds, EBTs, non-DOM settlors. But for your typical client, since 2006, trusts, I think lifetime trusts are basically ruled out. In 1975, when some of us may be old enough to remember, when capital transfer tax was introduced, I'm not one of them, by the way, when capital transfer CTT was introduced, some people just said, well, I'm not going to, you could have made lifetime gifts subject to tax at a lower rate than the tax on charge on death. And many people said, well, I'll wait and see what happens. And people who took that view were proved right in 1986 because we went back on to inheritance tax and pets became possible once again. When in 2006 the new rules came in for the taxation of trusts, I think I would have taken the same view and said, well, okay, it's like this for a while. Let's wait till somebody comes in who understands these things and puts it all right. But it never happened, slightly to my surprise. Actually, the reform, I shouldn't have been surprised because the reforms I predict never happen, and those I never think of what does happen. Now I think it is time to accept that the position we're in is not going to change in for the medium term. Eventually, perhaps it might. And therefore, even although the topic I'm talking about is not new, it's been around since 2006, it's not going to go away. That could explain why we have such a wonderful turnout here this morning. So paragraph 2, why did we use what I call conventional trusts? Well, we had separation of management and beneficial ownership. I could be the trustee, I could look after it on behalf of the money on behalf of my children. I could make them trustees if I wanted and keep them off if I wanted. Flexibility of beneficial ownership, power of appointment, move property around from one beneficiary to another, and asset protection. Disadvantages, I don't need to tell you, administration costs, finding trustees. I quite favour these days setting up a company. It can be a UK resident company for a UK trust, or 2 of them if you need 2 companies, and appointing them to be the trustees. Then when you want to change the effective trustees, you just appoint new directors. If you have a trust which has been around for a while, with a long chain of appointment as you get on new trustees and indemnities and so on, life is much easier if you do it that way. But anyway, you have to find trustees. And of course, trusts do lead to trust disputes. My pupil master, Mark Herbert, told me once, gloomily you may think, everyone who creates trusts regrets it. Now, maybe that was his experience as a trust litigator, because he wasn't instructed to advise on the trusts where the beneficiaries and so on were all perfectly happy. But that was what he told me, and I've often thought about that since. But it seems to me, even if it's true, or to the extent that it's true, people who don't create trusts may also come to regret it. If I say, right, I'll make a lifetime gift to my children because trusts are just too complicated, I may come to regret that. If I say I won't do it at all and then it remains in my estate until I die, well, my children might come to regret that. So there are no perfectly safe routes. And I think one might be unduly gloomy about that. So baseline option, do nothing, make provision by will. Downside, as I've said, I don't need to tell you, inheritance tax on the death, subject to perhaps to planning. Upside, capital gains tax, uplift on the death. As far as planning is concerned, the obvious thing to do would be to invest, if you could time it right, in property qualifying for business property relief. It might be AIM shares, and it might be Lloyd's underwriting business, something like that. It can be the whole estate, part of the estate. If you can hold it for 2 years, and if, which is an important if, the relief is still. We have seats down here, by the way, for especially reserved for the latecomers as a sort of penalty, and anyone whose phone goes off, by the way. Yeah, so if you can time it right, then that would be great, and you might lose out of it, but unless the values go down 40%, you're likely to be ahead. The upside, capital gains tax rebasing on death. As many people here will know, the Office of Tax Simplification recommended that this relief should be abolished. They decided to abolish the OTS instead. It might be around in the future, it might not, who knows. So what are the alternatives, since I've told you what we can't do? We have absolute gifts, I'm not going to say anything about that. Loans, family investment companies, bare trusts, which is the subject for Rebecca, family investment partnerships, which are very popular in America for some reason, a different tax system, of course. Family investment partnerships, they'll be discussed appropriately by Mary from the United States, who's going to talk to us electronically. So a brief word on loans before I come to family investment companies. I could make an interest-free loan, I could make an index-linked loan. Question as old as the hills, is the index linking subject to income tax, if it's paid, the revenue say it is. I put a offer in my book on drafting trusts. I'm afraid I've just broken the rule and plugged another book, never mind. I put an offer and I said, if anybody has this point and uses the precedents in my book, then I and some unlucky junior will represent them pro bono in the subsequent appeal. And the good thing about doing it in the way of my book is that the index linking goes both ways. So if the index comes down, you receive less. It's not just a one-way ratchet. And that, I think, it makes it look much less like interest. The cases where people come to me saying, oh, I've got this dispute, would you be kind enough to act? They've never done that. They didn't actually use my book. So I felt quite free to say, no, well, good luck to you, but I'm not going to do it pro bono. I'm not even sure I'd want to do it at all. Anyway, but that's by the by, that's a point sooner or later. Hopefully we'll get greater clarity on that point. I've written here the child, if he borrows money, can't spend the money, brackets, or not so easily. The benefit of the loan remains in the estate of the lender. Well, that is a serious problem, but of course you could always waive it later, and that could be a pet. Remember, if you do that, you need a deed. You can't just do it informally. And in the meantime, and I think this is important, inflation will reduce the value of the debt. So debt for £1 million, say today, certainly won't be worth, well, that didn't say certainly, but it's unlikely to be worth £1 million in 10 years' time. And that reduction in value is free of inheritance tax. Non-tax aspects of loans, I've said there should be a written agreement. That's pretty basic. It is surprising how often people don't think about it. Think about the position following the death of the lender, or for that matter, the borrower. The time to think about that is before the death, not after the death. Consider whether any party to the loan needs independent legal advice. I wouldn't have thought so, but it's something to keep in mind. Limitation periods, which might make your loan worthless, which will come as a shock to the creditor. It's good for a loan to purchase a house. I've written down here very briefly, it's very basic. You avoid the high rate of stamp duty land tax compared to co-ownership. The owners can occupy, the lender doesn't have the right to occupy, the lender will get his money back, it can be secured on the property, everybody knows where they are, rather better than co-ownership from that point of view. Loan invested in a fund of securities, I lend £1 million to my son and say, right, you invest it. Interesting question, is this subject to, is it caught by section 64 settle or interest in settlements? You may say, well, it's not a settlement, but settlement is widely defined. It includes an arrangement. It's certainly an arrangement. So we have a settlement. Income which arises under a settlement, it's bottom of page 3 of my notes, treated for income tax purposes is the income of the settlor, that is the lender, and the settlor alone. If it arises during the life of the settlor from property in which the settlor has an interest. And if it's, we're looking at an interest-free loan here, the settlor does have an interest because the property can be used to repay the interest-free loan. So if you have a secured loan, I would have thought you're fairly clearly caught. You may not care because the rate of tax may be the same or more or less the same in either case. Otherwise, you might consider unsecured loans. Not obvious why they're not caught, but it does look rather better. Or perhaps even loans where the proceeds of the loan can't be used to repay the debt. That should be fairly safe. The settlor doesn't have an interest. So moving on from loans to the topic which I meant to be talking about, how we're doing for time, family investment company. So the general idea is I have a fund of money, I transfer it to a company by way of loan or share subscription. I arrange for my children, should we say, to have shares in the company. It can be as simple as that, and that's really quite attractive from an inheritance tax point of view, because if I have 3 children and each of them has 25%, I might keep 25% myself, then we have minority valuations. Even if we have a third, we have minority valuations in the asset. You'll be pleased if we had a charge to wealth tax, a one-off charge to wealth tax. You'll be pleased if you've done this because there would be a considerable saving. Will we have a charge to wealth tax? Well, I don't know. That's a simple thing, and then you can do more complicated arrangements, if you like, or more sophisticated dividend waivers. You might do, I'm going to talk about that. You could have voting shares and non-voting shares. I could give my children the non-voting shares. I might keep the voting shares, keep the control. That would be perfectly possible. Just remember, those voting shares will have a value, just because they don't have a right to income or capital on a winding up or not much. Doesn't mean they're worthless. So that's something to bear in mind in these arrangements. Alphabet shares I'm going to talk about, deferred shares I'm going to talk about. The big downer, and I've reached section 7 of my notes, of family companies, it seems to me, is corporation tax. An investment company is not going to qualify for the small profits rate, even if its profits are otherwise small, because it is a close investment holding company within the meaning of section 18N. So it's going to pay at the mainstream corporation tax rate, now 25%, higher than the capital gains tax rate. That takes a bit of getting used to, because it's some time, isn't it, since we had the state of affairs that companies pay capital gain on the high rate of tax on capital gains than individuals. That's where we now are. And then you have another rate of another tax charge if you want to extract property from this company. This is by way of repayment of a loan, perhaps. You'll have a dividend, which is subject to income tax. You'll have a liquidation, which, assuming it's not caught by any of the anti-avoidance rules, is subject to capital gains tax. Except for non-residents. I reckon this makes family companies pretty unattractive. Throw in the fact that once you're in, you can't get out, or you can wind up, but there's a heavy cost to getting out. It may be bad now, but it could be worse in a few years' time. So I would not myself put my family money into a family investment company. I would keep it out. And that takes us to bare trust and family partnerships, which my colleagues are talking about. And in a sense, it means I could sit down now and say, well, there's nothing else to say. And that's almost like that, but let's talk about some other things. These are ideas which might be used if you do have family investment companies, maybe talked about in other respects, or of course, they may be used for family companies which are not family investment companies. Section 8, we could make the thing non-resident. That might not be so bad, mightn't it? The gains will be attributed to the, under section 3 of the TCJA, we attribute the gains of the non-resident company to the participators. At what rate are they taxed? 20%. Better than having the company here and paying corporation tax. Income will be, the transferor will be subject to income if he has, quote, power to enjoy, which he might. That's not such a bad thing because he'll pay at his marginal rate. You won't have the double charge. You can take the money out of the company if you want. You'll pay tax on it once. Are you ahead after all that? Throw in the costs of it. I'll put down here, is a non-UK company practical? It ought to be practical, but we will need a client who is prepared to leave the central management and control to the your directors, non-resident directors. There's a whole lecture in that, isn't there? I wouldn't assume it's practical for all clients or easy. So much for non-resident companies. Let's have a word or two on dividend waivers. And the idea is this is basically income tax planning, isn't it? And it goes like this. I own some shares with my wife. I'm paying a higher rate of tax than my wife. It might be the other way around, but let's call it that way around. If I pay a dividend on the company, she'll pay income tax on her share of the dividends, and I will pay income tax on my share of the dividends. That's the first. There's an opportunity there for anybody else who wants to switch off their phone in time. I'm sorry about that. Where are we? Yes, dividend waivers. If I waive the dividend, she gets it, then are we ahead on the income tax front? And the answer is probably not. There have been two cases where this has been tried, and neither one did it work. One was Donovan, and the other was Buck. In Donovan, the wife had 20% of the shares, and the husband waived a dividend on his 80. In Buck, he had 999 shares and she only had one. He obviously didn't think much of the idea of transferring shares to his wife, Mr. Buck. So he waived the dividend on his 999 shares, and she got the dividend. And so the first tier tribunal in each case, this is caught by the settlement provisions. The waiver is a settlement. The waiving shareholder, that is the husband in these cases, is a settlor. The income arises from property in which he has an interest. And so he's taxed on the income, and the usual spouse exemption doesn't apply. So what I could do if your husband is actually on talking terms with his partner, or if the wife is on talking terms with her partner, give the other partner the shares. Then you'll be within the exemption for section 64. You can pay dividends and they'll go where you want. If the intention is to get beyond that, the difficulty that you don't want to give them the shares, then you just have to accept, I think, the income tax downside. I've set out here in my notes in some detail the revenue manual passage. Interesting point on 9.1.1. All both cases were husband and wife cases. Supposing it had been a child, not a wife, I give 20% of the shares to my son as a dividend and I waive. Is that caught? And the revenue seemed to say not. That strikes me as rather generous. But I don't think the taxpayers are going to complain, although there's a perfectly decent argument that that's caught too, because there's still property, namely the shares which the father has. So it's not a settlor excluded trust. And again, the amount of dividend, let's take the case of Buck. I have 80% and she has 20. And I waive the dividend. If I pay a dividend, she gets 20%, I get 80%. If I waive my dividend, she gets it all. Is the settlor interested trust charge on the additional bit? That is 4/5, or is it on the whole? I would have thought you could argue it was on the whole, but the revenue quite reasonably say no, we're only going to take the 80% at the higher rate. Again, some risk, I think, that might change. Let's move on, look at alphabet shares. So I've reached page 8 of my notes. What are alphabet shares? A shares, B shares, C shares, and so on through the alphabet. And the general idea is that the person with control of the company, whoever that may be, can say which of those classes of shares gets a dividend. So if I have 3 children, and I might even have shares of my own, or I might not, so ABC shares for each of my children, and for some reason I want the oldest to have some money, I could arrange to declare dividends on that share and not on the other shares. It's an idea which has been around a long time. There are old cases, and now the name of it was slipped me, but maybe somebody here can remember, from about 1945, where exactly this arrangement was done. It may even be older than that. And it's not so different from a partnership, where the partnership agreement might say that the partnership income is distributed to whichever partners the partners with control decide. So I don't think I would describe it as a contrived and artificial arrangement of the kind which brings in problems with DOTAS. But there's still this question: is it caught by settlement provisions? Is it a quote settlement, in a sense, an arrangement? Obviously, who is the settlor? The person with control. Does he have an interest? Well, he may or he may not. But if he does, then he'll be taxed on the income, and the arrangement won't work. And that's more or less what the revenues say in the extract from the manual. I'm not going to take you through it now. At the top of page 9. But let's look at it briefly. Mrs. I has 80 shares. Mr. I owns 20 shares. Here it's the wife who has the majority. And we arrange a dividend on the B shares. Court, say the revenue, and I certainly wouldn't fight this. by the settlement provisions. One case on it, it's like a unusual case called Patmore. I talk about it here in my notes. I'm not going to talk about it now. Now, let's move on briefly. Inheritance tax. Page 11, waiver of dividend. That's straightforward. That's not a transfer of value. Payment of a dividend on alphabet shares. Well, we have section 94 of the Inheritance Tax Act, which says if a close company makes a transfer of value, that is, it reduces the value of its estate, you don't charge tax on the company, but you do charge tax on the participator. If that payment is subject to income tax, this doesn't apply. So again, we are okay. Greater care is needed, isn't it, on creation of these alphabet shares? Because if I own a company and I say, oh yes, alphabet shares are a great idea, I'm going to make some. I may find that I had originally a good and valuable shareholding, and by the time I finished, I have shares which are not worth very much at all. And if that's what I've done, then that would be an occasion of charge under section 98, and I set it out here in my notes. It says alteration on close company share capital is a disposition. Well, what follows from that? It's a definition of transfer value for inheritance tax, which is a disposition, and now we have one, which reduces the value of the estate of the person making the disposition. So it would be easy, if you're not very careful, to create a charge for inheritance tax when you enter into these sorts of arrangements. And that, if you're going to do it at all, that's something to bear in mind. I'm a bit gloomy about alphabet shares myself. I've said down here, sometimes recommended playing with fire. But then here's the good news. The Revenue set up a unit to review the taxation of family companies, and they decided it was fine. They weren't going to make any changes. My guess is they said to themselves, look, we get the double charge. We're ahead, regardless of anything else. We don't need more than that. I don't know what they were actually thinking because the report was never published, but I wouldn't be surprised if that was it. Deferred shares, the last of my topics before we come and look at ChatGPT. I'm going to overrun slightly because we started a little bit late and Rebecca kindly gave me permission to do that. Deferred shares work basically like this. I give shares to my children, and the terms of the shares might be they get no income, they get no rights to capital for 30 years, and then on the 30th, after 30 years, they do. So the rights under the shares are deferred. At the time I give the shares to the children, they're not worth much. I don't see they're worth nothing, but the value must be discounted quite a lot by the deferral. My shares gradually decrease in value, their shares gradually increase in value. That's not an occasion of charge for inheritance tax. Say the Revenue. Well, there are two possible occasions of charge. One is on creating the deferred shares. Well, if you do it right, you can arrange it as a pet, so that's okay. And they say there's a charge when the deferred shares come into possession, if you call it that. Namely, after the 30 years, when suddenly they move from having no rights to having significant rights. But you can draft your way out of that, if you bear it in mind, by avoiding a sudden change from 0 to 30, and having a nice sort of gradual change over year 29, where they start to rise and more or less reach 30 after at the time that you want. And you can easily find a formula, well, not easily, but the more mathematically minded drafters will find a formula which will achieve that. So there's a problem and a solution if you want to go down the deferred shares route. I wouldn't myself create a company for the benefit of deferred shares, but if you have a company and you're thinking about tax planning, then that's not a bad way to do it. Now, let's move on to see what ChatGPT thought about these problems. So this was a question I set the computer. Please explain the advantages and disadvantages of a family investment company, and to make it easier, or the answer more focused, I pointed out that I was interested in the UK and not anything else. Answer: a family investment company, FIC, is a type of private limited company, perfectly correct, used to manage and hold investments on behalf of family. So far, so good. FICs are a popular choice for families. I wonder if that's right. I haven't seen many fixed myself. But I asked a colleague at lunch in Gray's Inn, and he said fix. He says obviously he'd seen a number of them. Even the abbreviation was relatively new to me. I don't know if they're popular, but I know where ChatGPT got that from. It got it from because, of course, ChatGPT works on the basis of a database, and the databases will include all the websites of the companies which market these arrangements, and they would describe it as popular. So I'm not quite sure about that, but I might be wrong, because I can only tell you what I see. We might discuss later over drinks just how popular they are. Never mind. Who wish to create a structure that can help manage their wealth and pass it to future generations. Yes, in the UK, there are a number of advantages and disadvantages associated with setting up and running a FIC. I mean, the quality is pretty good so far. So here are the advantages. Tax efficiency. FICs offer tax advantages over other investment structures. In particular, FICs are subject to corporation tax at a rate of 19%. Whoops. This was yesterday. I asked the question. Remember that ChatGPT has a closed database to 2021. So it doesn't keep in touch with what's happened after that. But if one was marking it as at 2021, then that's okay. Lower than the highest rate of income tax, 45%. Well, 46% in Scotland, but maybe we don't care about Scotland now. Now 47%. And the highest rate of capital gains tax, 28%. Well, what do we say about that? It is true that there are occasions where capital gains tax is paid at 28%, but not for the sort of investments which we're considering here, because 28% only applies to private residences and carried interest. So I think I wouldn't say that was right. This can result in significant tax savings for families with large investment portfolios. Well, it disregards the problem of extraction. It is true so far as the money remains in the company, the rate of tax will be less, or the rate of income tax may be less. Asset protection. FICs be an effective way of protecting family wealth from creditors and other third parties. Discuss. Assets held by the FIC are legally separate from the personal assets of the family member. True. And so protected from claims against the family. True. The claim will have to be against the family, against the shares. If the family member becomes insolvent or divorces, what would be in his estate is the shares, and those will be available to the creditor or the spouse. So I think that's basically wrong, I would say. Flexibility. FICs offer a high degree of flexibility in terms of how the company is managed. True. And how profits are distributed or whether they're distributed. That's true. This can be particularly useful for families who wish to structure their investments in a way that suits their specific needs and objectives. It is a fantastic achievement, ChatGPT. No doubt about it at all. If I'd asked, you would probably have converted that into a sonnet. Indeed, I'm sorry now that I didn't. But nevertheless, I think, ladies and gentlemen, our job is safe on this performance for a little bit longer. It would be an interesting question to come back in 10 years' time. I propose in 10 years' time to give the same lecture, to ask the successor of ChatGPT to be the same question. We'll see just how good it is, because it's only going to get better. Family investment companies, I think that's something of a specialist interest. I suppose you might be ahead if you had a company which received exempt distributions, so it didn't pay corporation tax, and then you had shareholders who then went non-resident. So at the end of the day, they took money out tax-free, something like that. If you have a family in just that situation, I can see you'll do it. In other circumstances, you might be ahead. But frankly, I would put my money into a bare trust or a family limited partnership. That takes me on quite conveniently then to our next lecture. And here we have Rebecca to tell us all about bare trusts. Oh, costs, I almost forgot. Costs. There's another page. And yes, setting up and running a FIC can be expensive, true. In terms of legal and professional fees, it doesn't give a quote, but there we are. Ongoing costs, accounting, well, the company will have to have accounts, obviously, and compliance factored into the financial planning. Complex to set up, not particularly, but I mean, you will want advisors to do it. The second sentence, the second paragraph, I think, just repeats the way what's in the first. It's a pretty good show, actually, for ChatGPT. If we had a beginner as a pupil or a trainee solicitor, would they do better? I don't know. I'll leave you to think about that. Rebecca, bare trusts.
Those of you who are paying attention, I hope at least can notice that I'm not a man called Salou. I've taken over for him at reasonably short notice due to some unforeseen work commitments. So unfortunately, you're going to have to listen to me for the next, I think, 20 minutes or so. So I'm going to be talking about bare trusts, and I'm going to start. It does work. Excellent. I'm going to start with the definition of a bare trust, and I'm sure everybody here knows what this is, but nevertheless important to start at the basics. So a bare trust is, in short, where trustees hold property on trust for one or more beneficiaries absolutely. Now, the term bare trust has various meanings, but nowadays private client practitioners use the word specifically to mean a trust of property which is within Section 60 TCJ 1992 and the income tax equivalent, in Section 4663 ITA, and not within Section 43 IHTA 1984, i.e. not settled property for IHT purposes. Now, these definitions are not quite identical, but in practice, they usually amount to the same thing. So when might we use bare trusts? Well, bare trust can be used where a settlor wishes to make an absolute gift without transferring legal title to the property to the beneficiaries. And a classic example of this, which is particularly relevant to this talk in the family context, is where the beneficiary is a child who is incapable of holding the legal title. Now, for as long as the bare trust is in existence, the management of the trust fund is in the hands of the trustees rather than the beneficiaries. And this is quite a significant advantage over an absolute gift in the sense of where beneficiaries are either children and incapable of holding legal title, or perhaps young adults, where there might be concern as to what might happen to an absolute gift.
Or older adults.
Or older adults. A bare trust can also be a vehicle to arrange that the value of an investment company, which doesn't qualify for IHT BPR, passes to children whilst retaining a single shareholder with control. So what are the tax advantages? Well, a bare trust is not a settlement for IHT purposes, and so it is outside the standard IHT trust regime for relevant property trusts. And this, of course, means we're not looking at 10-year charges or exit charges. And a gift to a bare trust is a potentially exempt transfer with the trust fund in the estate of the beneficiary. Now, the gains of a bare trust are the gains of the beneficiary for capital gains tax purposes. And so to briefly look at Section 60, and I promise I won't read the entire thing out, but what it says is that in relation to property held by a person as nominee for another person, or as trustee for another person absolutely entitled as against the trustee, or any person who would be so entitled but for being an infant or other person under disability, this act shall apply as if the property were vested in, and the acts of the nominee or trustee in relation to the property were the acts of the person or persons for whom he is the nominee or trustee. So what does this mean practically? Well, it means that in a CGT context, it's possible to use the annual allowances for beneficiaries. And whilst this might not be a significant advantage for a single bare trust, where the settlor has a number of children or grandchildren, the CGT advantage of a joint bare trust is slightly more substantial. Although, of course, that's a bit limited now because we've moved to 6,000 for the annual allowance, and then we're going to move again to 3,000, but nevertheless. Now, the income of the bare trust is the income of the beneficiary, unless the beneficiary is the minor children of the settlor as a result of the settlor interested trust provisions. And in practice, bare trusts are likely, therefore, to be made for grandchildren rather than children. And a bare trust used in a family context is not in principle a collective investment scheme. That obviously depends on circumstances, but the argument I think would be in most cases, this is because they are operated otherwise than by way of business. And I've set out there why. So moving then to the non-tax aspects of bare trusts. So if a sole beneficiary attains 18, they can call for the fund to be transferred to them. If a joint beneficiary attains 18, then they can call for their share of the trust fund to be transferred to them if it is easily divisible. However, the beneficiary may choose not to call for property to be transferred to them. And a beneficiary could be invited, for example, to sign an agreement stating that they wouldn't until a certain event happens, for example, attaining the age of 21. An alternative, the trustees can simply do nothing. What happens if a beneficiary dies? Well, the result will depend on both the age of the beneficiary and the terms of the bare trust. So if there is a sole beneficiary of a single bare trust who dies under the age of 18, their share would pass under the intestacy rules in principle to their parents, because a minor cannot make a valid will. And after the age of 18, their share will pass according to their will or the intestacy rules, whichever is applicable. Now, on the death of a beneficiary of a joint bare trust, if the beneficiary's share is held as tenants in common, the position is the same as I've just described it. Whereas if the beneficiary's share is held as joint tenants, it passes by survivorship to the other beneficiaries. Generally, bare trusts will not need trust accounts unless there are special circumstances. And if the trust just has an account with a fund manager, then the fund manager's report should in most circumstances suffice. And this, of course, makes administration easy. It is possible for a settlor to be the sole trustee of a bare trust. However, the position on the death of the trustee would need to be considered. I've set out section 36 of the Trustee Act. I don't intend to bore you through it, but it is there for if that circumstance occurred. So what can be done to protect the assets in a bare trust structure? Well, control over a bare trust is obviously illusory in many senses. And strictly a beneficiary upon attaining the age of 18 is absolutely entitled to call for the trust property. However, there are ways of mitigating this risk if there are concerns that a child or grandchild may squander the assets. So if there's more than one beneficiary, one thing you might want to do is invest the trust property into an indivisible asset, which would prevent an individual beneficiary then from being able to obtain their share. And I've set out some examples there in the footnotes. However, this, and we discussed this, didn't we, at drinks, this would have to be done prior to the beneficiary actually calling for the assets, or it would be a breach of trust. But in practice, there are likely to be conversations which indicate that this is what a beneficiary might be considering doing. Another idea as well would be to invest in an asset which needs everyone's agreement to sell and keep 1%. So looking at the powers of trustees of bare trusts. So there are two key questions when considering this. The first is what powers can be conferred on trustees, which are consistent with the trust qualifying as a bare trust in the tax sense. And then secondly, what powers are actually conferred on the trustees in a particular case. And the latter is, of course, construing the trust document. So the first power I want to look at is the power of advancement. So a bare trust may contain a power of advancement, which is the power to apply capital to or for the benefit of a beneficiary of a trust. But in fact, the power will generally be implied if it is not expressly included. And I've set out in some detail in the footnote there, which again, I won't bother reading out how that works. So this, as I've said, allows the trustees to apply the capital of each beneficiary share for the benefit of the beneficiary. And it would also authorize the trustees to transfer the beneficiary share to a new substantive trust if this was for the benefit of the beneficiary. The creation of the substantive trust is not in principle a transfer of value for inheritance tax purposes. And it's considered that the beneficiary is the settlor for tax purposes, but the contrary is arguable. And not to, again, plug James's book, but please see James's book. The next power I just want to briefly look at is the power to appropriate and to mix funds. And so the trustees may also have the power to blend funds of joint beneficiaries together or to appropriate assets to a beneficiary. Moving then to the fund that is the trust registration service. So there is no specific exclusion for bare trusts. As a general principle, if a bare trust is an express trust, as it would be here, it should register on the TRS. A bare trust is classed as a non-taxable trust, as the beneficiaries are the ones who are liable for the tax, as I've just run through. And as such, the deadline for non-taxable trusts to register, which were created pre-6th of October 2020, was on or before the 1st of September 2022. Non-taxable trusts created after the 6th of October 2020 need to register within 90 days of becoming of being created or becoming liable to tax, or on or before the 1st of September 2022, whichever is later. Now, there is a £5,000 penalty for failing to register the trust on time, or where the register is not kept up to date, provided this is done deliberately. Now, deliberately in a tax context has a very specific meaning, and this was considered in HMRC and Tooth, and it was held there that there had to be an intention on the part of the taxpayer to mislead the revenue as to the truth of the relevant statements in order for there to be deliberate behaviour. So just to provide some context as to what that might mean here. There are, however, you'll be delighted to know, several exceptions to this, which may apply to common bare trust arrangements. And here you'll be looking at Schedule 3A. Of particular relevance may be bank accounts for minors. Now, the exclusion from registration there only extends to trusts created when opening cash deposit accounts. Trusts holding investments, for example, stocks and shares for the benefit of a minor child, will not qualify for this exclusion. And I also just want to note, because I find this fascinating, that historic pilot trusts, so those pre-6th of October 2020, are excluded, but those now aren't, which seems entirely mad to me, but there we go. So reporting for bare trusts. So trustees of a bare trust are not relevant trustees, as they are not trustees of a settlement. And although they are persons, they are not normally subject to reporting duties. Now, if we look at HMRC's manual, this says as follows. So a bare or simple trust is one in which each beneficiary has an immediate and absolute title to both capital and income. The beneficiary of a bare trust is taxable on the trust income and gains. Beneficiaries must include trust income and gains in any tax return they are required to complete. The trustees of a bare trust may pay the tax due to HM Revenue and Customs on behalf of beneficiary, but it is the beneficiary who is strictly chargeable to tax. And crucially, the trustees are not required to make a tax return. They may complete the trust and estate tax return and account for any basic rate tax due on income. However, bare trustees cannot return capital gains or any gains on life insurance policies, life annuities, or capital redemption policies, and these continue to be the beneficiary's responsibility only. So the second point there is based on the CGT bare trust disregard. In terms of the first point, there's no express statutory provision for this, but the rule is obviously a sensible one. The practice does not apply if bare trustees retain funds for their own benefit in breach of trust. Again, you can see James's chapter on that at chapter 118. So in conclusion, a family bare trust can be useful where there is a desire to make an absolute gift without transferring legal title to the property to the beneficiaries. They are also administratively comparatively simple, with reasonably straightforward tax consequences as set out above. However, care should be taken on drafting to ensure that it is in fact a bare trust which has been created. And I won't read out the HMRC guidance, but essentially they simply make the point that the actual terms need to be looked at quite carefully to check that another type of trust has not been made. And once again, to plug James for examples, for examples of how to draft bare trust, look at his book.
Yeah.
There we go.
Rebecca, thanks very much. I must say, so on, yeah. I mean, I quite like bare trusts, I must say. In various situations, it seems to me they're quite a useful thing to do. I don't know how often it's done, but I recommend it to you to think about. One situation is if you have a grandfather who wants to provide a fund for his grandchildren towards them buying a flat or a house when they reach an age when they're ready to do that. So if he has 8 or 10 grandchildren, shall we say, he sets up a fund, he declares himself or one of the children or whoever in members of the family to be trustees of this fund. They hold on trust for the grandchildren. As each grandchild reaches the age of 18, they're entitled to call for the property. In practice, it's not very likely. They'll come along and demand, unless they possibly go insolvent or get divorced, it's not very likely they're going to come along and demand this money. Even from their own private point of view, it would be a foolish thing to do, because unless there's a tremendous falling out, because this won't be the only expectancy they may have on the family, and it wouldn't be sensible to have a financial row with the parents. But in practice, they don't even need the money particularly until they buy a flat. And at that point, you'll turn to them and say, right, this is what the fund is for. Here's a check. It's a bare trust. So if another grandchild is born, the grandfather has to put in some more money, perhaps equal to the share of the other existing grandchildren, something like that, in order to bring about equality. But that, I think, is one situation where it works quite nicely. A second situation, you might have in the fortunate situation of a parent with adult children who, not so young, approve themselves to be financially sensible. If the parent or grandfather, for that matter, has money which he doesn't need himself, what's the inheritance tax planning? Well, the basic principle of inheritance tax planning: give away what you don't need. How do you do it? You could give it to a gift for the children in equal shares as a bare trust. What's the difference between that and simply making a cash gift to each of them separately? If they want to spend the money, they have to go along to the trustee and have a conversation. They may be entitled to call for that money, but they have to have that conversation. And that's the sort of protection which it will give you. It's not as good as a protection as a conventional trust, but I think it's pretty good. The third situation where you might consider this sort of thing is if you have a family company, hold all the shares on the terms of a bare trust. The children cannot call for their shares because although shares can be divided, this is a situation where the trustee has, for say, 100% of the shares, and if somebody comes along and says, give me a third, so I'm entitled to a third in equity, that would leave the trustee with 2/3, not the same powers. And in that situation, the beneficiary can't come along and say, transfer these shares to me. So it's a convenient way of holding all these assets, in each case, without returns, without a great deal of administration other than PRS, possibly even without accounts, if it's clear enough what the financial position is from the fund manager, or with a company which doesn't declare dividends. So in all those situations, it's a solution which I quite like. Perfect, no, but good enough. Now that takes us to 15:15, and we're running ahead, which will give us more time for questions, or possibly more time for drinking, depending how we go. Can we get Mary online?
I am here. Okay, so I think
you've been listening, Mary. Nice to see you. You've been listening to what's been going on so far.
yes, I have. Been going good, I think. I was going to say
you have the floor.
Yeah, so like you, James, I looked at ChatGPT in a slightly different context, though, because I was hoping to start the talk off with some sort of joke about family limited partnerships. I asked ChatGPT, jokes were appalling and embarrassing, so no one gets a joke. I'm sorry. We're just going to have to skip to the boring parts. But for those who don't know, my name is Mary Ashley. I am a barrister at Old Square Tax Chambers. I really wish I could have been there today. Circumstances didn't allow it, but I will be there next time I'm speaking. So without further ado, I'll put my slides up and we can get on with it. So let me just. Hopefully everyone can see my slides, I think. Okay, so today, I plan on covering the following topics in relation to family limited investment partnerships. First, I will consider what a family limited partnership is. This will involve an exploration of which type of partnership is most appropriate to use in a family limited partnership. In looking at that question, I will also look at whether there would be a collective investment scheme, what this would mean, and whether there would be a unit trust. I will then go on to look at the taxation of family limited partnerships. Finally, I will look at the advantages and disadvantages of using a family limited partnership. So a family limited partnership is basically a legal entity created by a donor for their family to manage assets and minimize tax liabilities. They really came into use after the changes to the inheritance tax treatment of trusts in 2006. The expansion of the relevant property regime meant that the use of trusts was now less attractive. The purpose of using a family limited partnership is twofold. First, it is to take the property out of a person's estate for inheritance tax purposes without making an outright gift. And second, to maintain control over the assets without being subject to the relevant property regime. In the great scheme of tax complexities, provided you understand the basics of partnership taxation, the tax treatment of a family limited partnership is actually relatively straightforward. For this reason, I'm going to be spending actually a fair bit of time looking at the mechanics of setting one up, and mainly what sort of partnership vehicle would be or could be most appropriate. So this brings us to our first question. Limited partnership, and in that I'm including a private fund limited partnership, or also a limited liability partnership. So let's look at them all in a bit more detail, see which one might be best. So the first type of partnership I wanted to look at is the limited liability partnership. The reason I want to consider it first is because it can be dismissed relatively quickly as an inappropriate vehicle for a family limited partnership. So as a lot of people will know, your limited liability partnerships are partnerships established under the limited liability professional or trading partnerships, enabling those members involved in the business to limit their liability for the limited liability partnership's debts and obligations. They are also used as investment partnerships in some hedge fund structures. Limited liability partnerships have drawbacks in terms of registration, administration, and publication. A person setting up a family limited partnership is unlikely to want these burdens. The majority of the law applicable to limited liability partnerships is modified company law. This means that a limited liability partnership must disclose information about itself on the public register. This will include details of its registered office, its members, its accounts and reports, and its charges. These regulatory requirements are both time-consuming and add further scrutiny. Given this, in most scenarios, a limited liability partnership would not be the first choice in creating a family limited partnership. So this brings us to our next type of partnership, probably the one with the share size they end up with. If a limited partner takes part in the management of the business, then they will lose their limited liability. Now, in terms of how long the limited partnership will last, it is governed by the rules for general partnerships. The length of time for which it can run can therefore be, first, for a fixed term, in which case it is automatically dissolved at the expiration of the term. It could be for a single adventure or undertaking, which is dissolved at the termination of it. Or finally, it can be a limited partnership at will, and so it may be terminated at any time by notice given by the general partner. Given the goals of a family limited partnership, there are features of a limited partnership. The key point is that the limited partner's control over the assets of the partnership is limited. They basically will have the right to the assets in accordance with the decisions made by the general partner, but otherwise, their control over the assets in the partnership is minimal. To this end, the partnership by notice. These advantages are baked in the cake, so to speak, with limited partnerships. They can also be obtained, however, by a general partnership with appropriate provisions in the partnership deed. In terms of other filing obligations, a limited partnership with an individual as the general partner is not required to properly run the partnership and to be able to calculate relevant tax liabilities for the partners. It will be necessary to draw up annual accounts. In my view, a limited partnership is likely to be a good option for a family limited partnership. However, it does not come without any cost. The first obvious cost will be the administrative costs associated with both registering and administering the limited partnership. In terms of ongoing costs, this will include not only the cost of ensuring the proper accounts are drawn up and all tax liabilities are paid. A limited partnership can be designated as a private fund limited partnership if it is a limited partnership in writing that is a collective investment scheme. A private fund limited partnership is a slightly more flexible version of a limited partnership. The additional flexibility offered, however, may not ultimately be desirable in a family limited partnership. First, in a private fund limited partnership, the limited partners are able to take a more active role in the operation of the limited partnership without losing their limited liability. Fund limited partnership, there are fewer filing obligations when there are changes to the partnership than if you are looking at just a typical limited partnership. However, out how the partnership is to work and the rights and obligations of the partners. There is no requirement to register a general partnership. In a general partnership, each partner will have both the ability to take part in the management of the partnership business and unlimited liability. There is no requirement to file accounts unless each member is a limited company. The key disadvantage of using a general partnership as opposed to a limited partnership is that it is not possible to limit the involvement of the partners in the management of the partnership business in the same way you can with a limited partnership, whilst also getting limited liability. Given that the donor to a family limited partnership will want to limit who can manage the assets, it is unlikely that a general partnership will be the preferred route, unless the risk of being a collective investment scheme is seen as too great or too burdensome. So comparing the different types of partnership, as I said, it is likely that most donors will want to use a limited partnership, but this does create the risk of a collective investment scheme. This will be a concern for the general partner or operator, because if it is a collective investment scheme, then additional rules and regulations will apply to it. If those rules are broken, then there is a risk of FCA criminal sanction. So if we look at what a collective scheme is, it is defined in Section 235 of the Financial Services and Markets Act 2000. So a collective investment scheme will be your arrangement with the following characteristics. So first, it must be an arrangement with respect to property of any description, the purpose or effect of which must be to enable persons taking part in the arrangements to participate in or receive profits or income arising from the property. The family limited partnership is a partnership, so it would be an arrangement with respect to property, the property being the assets provided by the donor. The purpose of a family limited partnership is ultimately to enable the partners to participate in the profits arising from the property. The second requirement is that under the arrangements, the participants in the arrangement cannot have day-to-day control over the management of the property. This would be the case in a limited partnership. This requirement could, however, be avoided through the use of a general partnership. Third, the arrangements must also have either or both of the following characteristics. First, the contributions of the participants and the profits or income out of which payments are to be made to them are pooled. And or second, the property is managed as a whole by or on behalf of the operator of the scheme. This third condition would be met in relation to a family limited partnership, as at the very least, the property will be managed by the general partner or partners who would be the operator of the scheme. Given that the most likely vehicle to be used for a family limited partnership will be a limited partnership, there is a high risk that it will be an unregulated collective investment scheme. There are certain exemptions from being a collective investment scheme. In particular, arrangements do not amount to a collective investment scheme if they are operated otherwise than by way of business. To be a partnership, the arrangement will need to be operated as a business, so it is unlikely that this exemption would apply for the whole arrangement. If it were to apply, then the requirements to be a partnership would likely not be met. So instead, there would be a co-ownership arrangement. Whether this matters for tax purposes will be considered shortly. Under the assumption that there is an unregulated collective investment scheme, the operator will be subject to FCA regulation if they are carrying on their activities in relation to the collective investment scheme by way of business. In relation to certain activities, a person will only be regarded as carrying them on by way of business if they carry on the business of engaging in one or more of such activities. This exemption could potentially apply to the sorts of activities one would expect to see in a family limited partnership. The FCA has provided guidance in the Perimeter Guidance Manual on when a regulated activity is being carried on, quote, by way of business. It is a question of fact, and I have listed some of the factors that they will take into account in your notes. If the operator is carrying on a regulated activity, then it is a criminal offense to operate the collective scheme without proper authorization by the Financial Conduct Authority. Given this risk, in the first instance, some clients may prefer to avoid coming within FCA regulation at all. So to that end, one can opt to ensure that each partner does have day-to-day control over the management of the property so that there's no collective investment scheme in the first place. As I've said, this is probably not what people want overall, but it is an option. Alternatively, the operator can attempt to come within the exemptions to be authorized. This is a fact-sensitive question. Given the severity of the punishments, if this is gotten wrong, I would not suggest trying to get around these requirements through manipulating the factors which the FCA has provided. It is likely that the best option is to instead have the operator of the scheme be an FCA-regulated person. The general partner can properly delegate the day-to-day control over the management of the assets to an FCA-authorized investor to operate the collective investment scheme or family limited partnership. This would include delegating the power to make investment decisions and also the ability to promote, establish, operate, and wind up the family limited partnership. Whilst delegating these aspects will obviously create an additional cost in running the family limited partnership, it is better than the costs if this goes wrong. So before considering the more specific aspects of operating the partnership in greater detail, I do think it is worth addressing whether there is a unit trust scheme. A unit trust scheme is defined as a collective investment scheme under which the property is held on trust for the participants. Now, it is arguable in the first instance that a limited partnership would not be a unit trust on the basis that the property is not held on trust just for the participants. For the purposes of a unit trust scheme, the participants only include the limited partners. In circumstances, therefore, where the general partners also hold shares in the partnership, it cannot be said that the property is held on trust just for the participants. It is also arguable that the relationship between the general partners and the limited partners is not one where the property is properly characterized as held on trust. In any event, if the limited partnership is a unit trust, the tax treatment would be the same given the exemptions for income tax and capital gains tax for limited partnerships. Under the assumption, therefore, that we have decided that we want to operate a family limited partnership through a partnership, regardless of which specific type the partnership should be, the members of the partnership must ensure that they are carrying on a business with a view to profit. The business of a family limited partnership will almost always be that of making investments. To confirm, this will be sufficient to constitute a business for the purposes of creating a partnership. If there's any doubt, HMRC do agree with this point. But what happens if there isn't a business? In the event that the family limited partnership is not, in fact, carrying on a business, then the assets of the family limited partnership would be owned by the various parties as co-owners. Under the assumption that the partnership has been set up primarily for tax purposes, this will not be the end of the world. The primary tax treatment, which I will get to shortly, will be effectively the same. There are some minor tax differences. However, these tax differences will not usually have a huge impact on the decisions made by persons who are setting up family limited partnerships. I have listed in your notes the areas where it may be slightly different. So moving on to who can be a partner. A partner can be an individual or a separate legal entity, such as a company. So an adult with capacity can clearly enter into a partnership. That being said, in deciding whether or not to join the partnership, the adults may need to consider taking independent advice. This will especially be a concern where potential liability is unlimited. Given that family limited partnerships are designed for succession planning, minors are likely to be involved. Minors cannot enter into the partnership agreement themselves. The donor can consider instead establishing a bare trust for the benefit of the child to which a gift can be made. The bare trustee would then enter into the partnership as the trustee of a bare trust. Upon turning 18, the arrangements can either continue or the child can join the partnership as a partner. A donor and their spouse can be partners. And finally, I mentioned that consideration can be given to using a company with limited liability as the general partner. If you do choose to do this, you need to bear in mind that your requirements for filing accounts may change. The family limited partnership will continue for the life of the partnership. Unlike with trusts, there are no perpetuity periods, so they can go on basically forever. The partnership agreement can specify the basis upon which the partnership will end. The partners can decide to wind up the partnership under the terms of the partnership agreement, or they can apply to court to do so. A court may order dissolution of a partnership in various cases. This will include whenever, in any case, circumstances have arisen which, in the opinion of the court, render it just and equitable that the partnership be dissolved. This point is particularly relevant when we consider distributions. In terms of changes to the partnership during its lifetime, the partners will need to specify what to do in the event of the death of a partner or in the death of a beneficiary of a bare trust, and they'll want to include it in the partnership agreement. The partnership agreement can be drafted to provide flexibility in terms of partnership resignation and addition. Regardless of the type of partnership used, the partnership deed should provide that a partner cannot assign their interest without the consent of all the partners. So the last point to consider before delving into the tax consequences is distributions. The general partner can specify whether or not there will be distributions. Whilst the general partner can decide not to distribute profits and instead to reinvest those profits in the partnership, they will need to ensure that they distribute enough profits to cover the various partners' tax liabilities for the tax year. Otherwise, there is flexibility in determining how to deal with distributions, who should get what share of the income, whether to make loans to partners, etc. Despite the flexibility, however, a general partner will want to consider the consequences of any distributions before making them. For example, a general partner could choose to make no distributions But in that case, without commercial justification, there could be scope for a dissatisfied limited partner to petition the court for dissolution. Alternatively, a partner could choose to make a distribution to only one limited partner, but then there's a risk that a different limited partner could petition the court to dissolve the partnership. If the general partner chooses to make loans, if they are not on commercial terms and not offered to all partners, again, you have the risk of a dissatisfied limited partner trying to petition the court. So now we can move on to the tax treatment of family limited partnerships. Given that they will be used primarily for inheritance tax purposes, I will start here. So the gift of the property to the partnership would, in principle, be a potentially exempt transfer. As such, provided the donor survives 7 years, it will fall outside of their inheritance tax estate. If the donor decides to have a share in the family limited partnership, then this will form part of their estate for inheritance tax purposes. In this case, the donor will need to consider appropriate planning for their share. A family limited partnership is not a settlement for inheritance tax purposes. It is therefore outside of the relevant property regime. The reservation of benefit rules will need to be watched. Ultimately, they are unlikely to cause significant problems. There will not be a reservation of benefit provided that, under the terms of the partnership deed, the donor enjoys no benefit from the gifted partnership share and possession and enjoyment is assumed by the donee. To that end, the donor should only receive income by virtue of the partnership share they have retained. Consideration can also be given to distributing income in the first year after setting up the partnership to the partners, so their full enjoyment is clear. There is no reservation of benefit merely because the donor retains control over investment policy and the distribution of profits. Strictly speaking, the donor should not take remuneration for managing the partnership. In practice, however, HMRC do not take the point. So turning now to capital gains tax. A partnership, as many will know, is transparent for capital gains tax purposes, and a family limited partnership will be no different. The transfer of assets to a partnership is a disposal on which chargeable gains would be subject to capital gains tax. This would be in accordance with Statement of Practice D12. Whilst the family limited partnership is ongoing, partnership gains accrue to the partners individually and are taxed according to their share. Where minor children of a donor are partners, then gains will be charged on the children, not the donor. Where there are many partners, for example, grandchildren, then the partnership allows for efficient use of their annual exemptions. Now, as already been addressed by Rebecca, this was a far greater advantage when the annual exempt amount was £12,300. Obviously, it is reduced and it's going to reduce further, so the capital gains tax advantages one gets have lessened. Now, finally, on to income tax. A partnership is transparent for income tax purposes. This means that tax is charged on the partners in accordance with their shares. A family limited partnership will constitute a settlement for the purposes of the settlement provisions. The creation of a partnership can be regarded as an arrangement. There would be the requisite element of bounty in a family limited partnership, as usually there will be a donor or donors giving shares in the family limited partnership to others who will not have provided anything or very nominal amounts to the partnership. The donor or settler will be subject to income tax on the income arising to the family limited partnership if it arises during their life from property in which they have an interest. Given this, the settler should only be liable for income tax to the extent that they hold a share in the family limited partnership. They will not be subject to income tax on all of the income of the family limited partnership. The donor or settler will also be liable to income tax on income paid to or for the benefit of an unmarried minor child. As such, while the children of the donor are under 18, there would be no income tax advantage. In contrast, for adult children of the donor, a family limited partnership can offer income tax advantages similar to those offered by interest in possession trusts. A partnership is better for income tax purposes than a discretionary trust, as it does avoid the complex and expensive provisions relating to the trust's rate of tax. So having looked at both the operation and taxation of family limited partnerships, I think it's helpful now to consider the advantages and disadvantages to them. In terms of advantages, there is the clear inheritance tax advantage. The primary benefit of a family limited partnership is that it can reduce inheritance tax as the assets held in the partnership are not considered part of a donor's estate for inheritance tax purposes. It is particularly beneficial because this advantage can be obtained without relevant property regime charges and without having to make an outright gift of the assets to the intended beneficiaries. This then leads to a second advantage, which is the retention of flexibility and control in relation to the assets. The donor is able to retain an element of control over the assets, whilst at the same time allowing the other partners to benefit from the income generated by those assets and ultimately from the assets themselves. This allows for flexibility in terms of managing and distributing assets. Finally, there are some income tax and capital gains tax savings. As discussed, however, they are relatively minor and so would not be a big reason behind a decision to set up a family limited partnership. Now, whilst there are some clear advantages, there are also some potential disadvantages that have to be considered. First, there will be costs associated with a family limited partnership. Setting up a family limited partnership needs professional advice. The cost of such advice will vary depending upon what type of firm one uses. There are also likely to be ongoing costs. An FCA authorized individual may be required to operate the family limited partnership and manage the assets. Proper accounts of the profits should also be maintained, which may come at a cost if an accountant is used. Ultimately, whether or not it is worth setting up a family partnership will come down to the individual factors affecting each donor. These include, for example, the amounts involved, the driving reason for setting up the family limited partnership, the circumstances of the intended beneficiaries, etc. Second, a family limited partnership is not going to be appropriate for all assets. A holiday home regularly used by the family would not be a suitable asset to put in a family investment partnership. Assets benefiting from other inheritance tax reliefs also do not need to be placed in a family investment partnership. Investment funds are really the only appropriate assets. Finally, the other partners will need to undertake their own inheritance tax planning. Their interest in the family limited partnership will be within their estates for UK inheritance tax purposes. Those partners may, therefore, need to take their own tax advice to establish what steps they will want to take, bearing in mind the partnership agreement in their own circumstances. So just to finish up, there are a few more points I want to make. First, any well-run partnership will need to ensure that they keep proper accounts. This shouldn't be too difficult. The accounts are unlikely to be very complex. This is given that family limited partnerships will not be carrying on a trade. It is also important to ensure that the relevant legal requirements are followed, depending on what type of partnership is used. Some legal requirements will be more or less important for tax purposes, but if and to the extent that other requirements need to be complied with, including, for example, any FCA requirements, then care must be taken. Lastly, the partners, and in particular, the general partner, will need to understand the partnership agreement and what their rights and obligations are under it. Now, I want to end just by considering what HMRC may think about this planning. Now, this planning is not the sort of planning which HMRC will want to inquire into on the basis of it being egregious tax avoidance. They are clearly aware of it as a planning tool, but all they have said is, you may come across family limited partnerships. These entities are generally used as an alternative to trusts in inheritance tax planning. So they don't have that much to say about it so far. Now, that being said, simply because this may not be the sort of planning that is on HMRC's radar does not mean that it does not need to be carried out properly. As always, proper implementation will be important. For example, the donor will need to take appropriate care to ensure that they do not inadvertently create, for example, a reservation of benefit problem by taking more income than they were allowed. There are a few potential areas for missteps with family limited partnerships, but these can all be easily avoided if the family limited partnership is run properly. So I think that covers everything I wanted to say, and we can now move on to questions. James.
Mary, thank you very much. The way I propose to deal with questions is let's take questions from the audience here in person, first of all. And then at some point, we'll take questions from those who are watching us online, who are there in person in their rooms. If you're watching this on YouTube, you're not going to be watching this on YouTube because this part of the session is not being recorded. In fact, Dylan, have you switched off the recordings?
Yes.
Yes, that's great. That's great. So over to you. Do you have any questions?
It's on.
Okay, I'll start.
Please. Guys, you're on.
You talked about the use of non-nuclear resident companies. For the
Yes.
fix. What about non-resident partnerships? If obviously there will be a bigger, you don't have the principle. There's also a limited partner. No, I think I'm done.
Right. So the question is, what about non-resident partnerships? Now, I think my answer to that is the residence for partnership won't normally matter, will it, for income tax or capital gains tax?
But if then
Because they're transparent. Sorry. A non-resident partnership holds an underlying company.
where you can then obviously.
Why would you want that as opposed to holding the company directly? What's the difference? Who would the partners be? You'll find a couple of friendly bodies to be partners in a partnership, and they would hold the underlying company. Well, no, who would be the partners in this case?
You can keep it open.
Yes,
To.
yes. I mean, yes, I mean, I find it little bit difficult to see why you'd want to do that, even if you could. Because the income would still be the income of the partners, wherever the partnership is resident. What would it differently? Partnership residence doesn't normally matter very much from a income tax, capital gains tax point of view. It might matter for inheritance tax if you're worried about situs, but then that's a specialist interest. I don't know if I've answered your question. I mean, the way I've said it doesn't arise, but maybe that's an answer. Any thoughts? No.
From a regulatory perspective, you might want it to be.
From a regulatory perspective, possibly. I've had some difficulty here because I wouldn't claim to be an expert in the field of regulation, but that is, I agree, that is without knowing more about it, risking anything, saying anything positive. I agree. The regulatory aspect might be relevant. Will end up being regulated somewhere else, perhaps, but that's another matter.
Family investment companies where the revenues that we don't.
Yes. I'm going to repeat the question, by the way, I can hear it, but in case people can't.
Yeah.
So for family investment companies where the revenue said we're comfortable that we're getting corporation tax and
Yes.
dividend tax, if you lent the money in and repaid the loan, so you were just paying corporation tax, do you think at that stage the revenue would start to take a greater interest?
That's a very interesting question. We had this question sent by email just before the conference started, and I didn't have time to think hard enough about it. If I own a company and I lend interest free to my own company, that is not a quote settlement. and therefore the settlement provisions don't apply. And this was decided a long time ago in a case called Levy, if you remember. And what the judge said in Levy was, well, there is not a quote settlement in the sense of an arrangement, because an arrangement needs an element of bounty or gratuitous intent, and that's not the case when you lend to your own company. If I lend to my children's company, or a company which which my children have shares as well as me, then that argument doesn't get you home, does it? Because you are there is an element of generosity or bounty or gratuitous intent, or whatever you want to call it, in making an interest-free loan. Then the question is, are we within, and maybe this is your question, will the settlement provisions apply so as to tax the settlor on the income of the company? Is that a question?
Yes, yeah, that's it.
Right, good. It's a good question, isn't it? In principle, you say, yes, why not? That's your starting point. It is a settlement, the settlor has an interest. So far, so good. The possible answer for the taxpayer is section 3 of the CTA 2009, which says the provisions of the Income Tax Act relating to the charge of income tax do not apply to income of a company. Well, we have provisions of the Income Tax Act, namely section 624. It relates to the charge to income tax. It doesn't apply to the income of a company if the company is UK resident. So if you look at section 3 by itself, you would say, well, that takes you out of the settlor interest in trust provisions. And you may say, why not? Because the revenue are getting their corporation tax. Then, so far, so good. I looked at this a little while ago in relation not to the settlement provision, but in relation to section 720, transfers of assets abroad, where a similar question arises. If you have a company abroad which has UK land is paying corporation tax, will the transferor be subject to tax under section 720 in relation to the income of that company? At first I thought not, but specifically because of section 3. I said, well, that takes you out. And then when I looked at it again, I was less optimistic. And I was scratching my head trying to remember why I was less optimistic, because rereading section 3, I agree with myself first time round, and not with myself second time round. And I think it may have been when you study the history of these provisions, they tend to suggest it doesn't work the way that you might think it does. That might have been it. If I'd had more notice of this question, I would have refreshed my memory on the point, and I'm probably giving you a better answer than I can at the moment. This is a very interesting point of very general application. Does anyone else in the audience have any comments on it, or indeed our speakers? Have you looked at this point? No. Has anyone here researched this point? I think the only person who's researched this point in this room is me, and I've forgotten it. I'm sorry I haven't completely answered the question with in the way that I would like. It's annoying me now, but there is so much one can't keep it all in one's head. Yeah, sorry. Yes, if it comes back to me, I'll tell you. And if you stay for drinks, we can continue the discussion then. That also answers the question which I was sent electronically. Any more questions in the room? Please.
Just the notes saying that the gift-free partnership is in principle a potentially exempt transfer.
Yes.
So what instances do you envisage when it wouldn't be PAT?
Sure. Supposing I am in partnership with my two colleagues, we have 1/3 share each. I make a gift of the partnership. It is a pet so far as it increases their estate. If I give 100 to the partnership, there is a pet in relation to 2/3 of the 100, but not in relation to the last third, because that's not a transfer value at all. It doesn't diminish the value of my estate. I think that's probably what you had in mind, Barry, when you said it.
Mm-hmm. Yeah. Yeah.
Yes.
Yes. Hopefully,
it's a circumstance which will be a charitable transfer. That's a good news, unless you have a trustee as partner, which is not what we're envisaging here. There was a question over here somewhere. Yes, we've touched on it. Please.
Back onto family investment companies and anti-avoidance.
Yes.
Do you think that a family investment company funded by way of a large shareholder loan that's interest-free is vulnerable to attack under transactions and securities?
If it's a non-resident, transactions in securities. Okay, sorry, I was thinking of the transfer assets from moment. Transactions in securities. Well, is the loan a security? is a question I ask myself, because if it is, then a security for the purposes of the transaction in securities rule, then certainly a repayment of the loan is a transaction in securities, and therefore subject to counteraction. I would say. But then but if it's a simple loan, and not a security, which is probably the sort of arrangement one is envisaging here, then I think it's quite a challenge, isn't it, for the revenue to say this is a quote security. And therefore, repayment of the loan, I say, or indeed making neither making nor repaying the loan constitute transactions in the securities, and you're okay. That's what I would say. Reassured by the fact that there's no obvious avoidance here, is there? I mean, loans to companies are made all the time, and repayments to of the loans. Companies are often funded by way of loan, and one doesn't normally worry about transactions in securities. Yeah, I think I would sleep easy. Personally, I would sleep easy on that one. I don't know if anybody else has a view. There's Williams, isn't there, where a loan was held to be a security. But if I remember rightly, that was an unusual loan, which was itself secured on gilts. And in the context of a tax avoidance scheme. In tax avoidance schemes, if it's sufficiently egregious, all bets are off, because the courts will just say anything they need to in order to do you down. Good question, though. ChatGPT didn't think of that one. Any more? Yes, please, over there.
With Alphabet shares, do you think there's a risk of DOTAS applying either the financial product hallmark or the inheritance tax hallmark?
The inheritance tax one, it has to be artificial and contrived, doesn't it? If I remember rightly. I wouldn't describe it as artificial and contrived unless there's something more going on than straightforward Alphabet shares. That leaves the income tax one. And I'll have to go back to the hallmarks again. Which one did you think might be in point?
I think there's a risk of the financial product hallmark on the basis there is a financial product which is a share, and it contains terms which it would not contain were it not for the income tax advantage.
Could be. It could be, couldn't it? I've not thought about that, but I think that's not such a bad point. Sorry, I don't mean that in a negative way. Yeah, I think I'd want to refresh my memory of the provisions before committing myself to that. It's very widely drafted, the DOTAS, isn't it? That's what it comes down to. And there are many things which one feels shouldn't. It's not frankly terribly artificial. I mean, ordinary company shares are also, I'm supposing they're ordinary shares and not Alphabet shares. Why would the same apply?
I think because with ordinary shares, they wouldn't contain a term which they wouldn't otherwise have contained.
Because of the tax, yes.
Yeah, because of the tax advantage.
Yeah. I think I'd add it to my list of things to think about before signing off on this. Comments, please. Anyone else? Does anyone else have a view on that? It's a good question.
A variation in partnership profit sharing ratios can trigger a disposal for capital gains tax. So what limitation does that place on the ability of a general partner to vary profit shares?
Certainly, if the profit share is 1/3, and you say, right, going forward it's 2/3, that according to the statement of practice is a disposal, isn't it? But supposing you say the profit share is such as the partners agree from year to year, which isn't uncommon provision in many partnerships. No one says that generates and in this year particularly, you say, right, it'll go to this partner. No one says that's a capital gains tax disposal, I don't think. Any views?
I agree with you, James.
No, please don't. Is it time? Can we get some, if we have electronic questions, can we get them on the screen?
They will be put on the screen if there are any. There isn't any currently.
No questions. All right. Oh, okay, that's good. And if we stop asking questions now, we can continue to talk and drink at the same time. It may or may not improve the quality of the answers or of the questions. But if you do have any more questions, now's the chance. No. Well, thank you. It's been a most enjoyable session to give. I hope we've given you a lot to think about. And we haven't, when's our next seminar? Remind me.
The next seminar is, there is a slide actually.
There's a slide. Can you get it up, Mary? Or can I get it up?
You might be able to.
Where's our
I'll go and get it.
thank you. Yeah, you can get that. Yes. Save the date. Robert, Harriet and Shane will be speaking on a subject I think to be announced. Shane, do you know your topics? You're still thinking about it. I think last time we talked about it, we said let's get this seminar done and then we'll pick a topic. If there's a topic you want us to talk about, now's the chance to lobby for it. Yes. Yes. So it does. Who did this? Who did this slide? Dylan.
Last minute.
Right. Good. Yes. June this year. Areas and emissions accepted, as they say. Excellent. I call the session to a close. Thank you very much indeed.